So earlier I made a video on 4 tips on how you can invest in your 40s so then you can be wealthy in your 50s. So in this video, I want to share a 3-step process for you to invest $100,000 in your 40s so then you can retire by 55. And this is my proposed plan. If I am 40 years old today and I have $100,000, what am I going to do with it so then I can retire by 55? So let's start with the goal. The goal is to have around $3 to $5 million by 55 years old. So then you don't need to work anymore and you can live off a passive income stream. Now you might think, wow, $3 to $5 million using $100,000. That's actually quite ambitious. And I would agree with you. And if you actually go to a Reddit or any forums and you kind of look at what financial independence people are aiming to get, is somewhere around 1 million. Maybe they can get away with 800K. So 1 million is the typical amount that people try to retire with. And I'm aiming for $3 to $5 million. And that is because I want to have some buffer. I want to live more comfortably. And, for investing, it is really a variable return. So then there's no guarantee. So that's why I like to have a larger balance to aim for before I consider retirement. And this is really designed when you're 40, because I think that when you're 40, you can be a bit more ambitious. You're not retiring in the next 5 years. You have around 10 to 15 years to invest and save. And I think you have time. So then you can be a bit more ambitious in terms of the amount of net worth you have at the end of 15 years, which is 55. And when you think about it, I did the calculation using compound interest with $100,000 in the very beginning. So this means the number I just provided you does not include any additional money you save. So you might even make more depending on how much money you save each year. So as a 40, let's assume you have $100,000. And for the next 10 years, you invest and you make around 30% return. So in 10 years, that's actually $1 million already. And from a million, which is when you're 50 years old, you can invest and earn 30% again. So then at 55, you'll be somewhere around $3 to $5 million in your investing account. So that's pretty good, right? So let's tackle the first problem, 30% return. Now this is a relatively high return, and if you look at the previous video, you can't really get that by investing in a mutual fund because mutual fund usually gives you around 7% return and you want 30. So that means when you are investing in the market, you need to be more selective. For example, Warren Buffett has around 50 to 60 investments. That's it. But when you look carefully at his portfolio, his top 10 to 15 investments consists of 90% of his portfolio. So he's a really focused investor. And when you think about the markets, there's around 2,000 stocks on NASDAQ. There's 2,000 stocks on New York Stock Exchange. There's another 2,000 stocks on Toronto Stock Exchange. You're not going to find 100 stocks that can grow 30% year after year. And it will be too time consuming for you. You have a full-time job. I know you're busy. So that means you need to be more focused than that. So based on my calculation and reading and studying Warren Buffett, for the next 15 years, you're really aiming for just around 20 companies that you think will give you that return. So when you think about that, wow, you're actually not investing that much. And you're right. And if you just kind of divide 20 companies across 15 years, then it will work out to be approximately 1 to 2 companies a year. Now, of course, you want to be fully invested, so then your portfolio will work for you. So that means I would assume you need to get around 5 to 7 opportunities or 5 to 7 companies a year in order for you to grow your account by 30% year after year. Now, the second tip I got for you is really to wait for the right time. So when it comes to your portfolio, you already know that you need to invest in 20, maybe 30 companies in total. So that means you need to invest in around 5 to 7 companies per year. So when you think about it, you actually have time. And if you want to make 30% a year, you need to get good at timing the markets. Now, a lot of people think you can't time the markets. There's no point in timing the markets. And there's a lot of research study tell you that you don't need to time the markets. But the truth is, timing does matter. And you won't get timing perfectly, but you should at least try your best to get into a stock at a discount. In terms of tools or techniques I like to use Bollinger Band. And it is a very famous technical indicator developed by Mr. Bollinger. And it is basically a statistical tool where it will look at the last 20 weeks or 20 days or 20 minutes of the chart's data and calculate what the upper band and the lower band is. So what does that mean? I actually explain a Bollinger Band in much greater detail within my free case study below, but a brief description is that imagine you have a bell curve and you want to capture 95% of the opportunities within the bell curve. You draw two lines and say that, okay, for the last 20 weeks, 20 days or so, most of the data points are within this curve. So this band, the upper and the lower band. So then that means if it is near the top of the band, chances are it's the high. And if it is near the lower part of the band, then chances are it's a low. So this will allow you to get into a stock at a discount. So it's much more efficient and it is very easy to see. So if you are not using Bollinger Band yet, then I would suggest you to add that to your chart because that will really help you out in terms of timing so that you can get in at a discount. So imagine you can get into a stock at a 10% discount. And then the stock is a good stock, obviously, and it goes back up by 10%. So by getting into a stock at a 10% discount, you are making 10% return when the stock reverts back to normal. Now, of course, in reality, it's a bit more complicated than that to use Bollinger Band, which is why I have the free case study below. So you can go to the first link and you can sign up and watch it in your spare time after this video. When you are able to master timing, that's when you're able to get an extraordinary return. So in Investing Accelerator, here you're going to see a case study from Teresa, and she made 78% from FedEx, the stock, using stock options. And she invested in FedEx when it was low, when it was at a discount. And this is actually shortly after COVID, when the market has taken a beating and the stock dropped a lot. So after doing some additional research using Bollinger Band, Teresa is able to figure out that FedEx is at a low, so then she invested. Within 3 months, Teresa made 78%. So congratulations, Teresa. The third and the final tip to invest your $100,000 is to really use leverage. Now, there are many forms of leverage. Personally, I don't like to use margin accounts. I have a margin account, but I don't use margin at all, even though I have it. I use something called stock options. And that is an advanced topic it's very confusing. And if you go online and research, chances are you're going to find 20 to 30 different option strategies with varying returns. But it is important for you to learn options or learn leverage, because once you're able to use leverage in your favor, then it will further multiply your return so that you can get to 30% return faster. So within Investing Accelerator, we learn how to use options, which is a form of leverage, and we also learn when not to use it. Because whenever you're learning a tool or a technique, it is important to learn when you are supposed to do something and when you're not supposed to do something. So here is another case study within the program where Adrian made 90% from Corning, which is GLW, and 95% from United Airlines. He invested with good timing because the stock market was down. So then he got in for both of these stocks at a discount, and he used stock options to multiply his return. So that's why you see that he's able to get close to almost 100% for these two stocks, because he used leverage, he got in at a good time, and he focused his portfolio such that he's only investing in the best opportunities only. He's not trying to invest in 100 stocks in the market. He's not trying to buy ETFs, but he focuses his capital so that he's only investing in around 5 to 7 companies a year. So that is pretty much it. If you want to learn more about investing and how to evaluate whether something is a good investment, then you want to click on the first link below so that you can watch the free case study. Now, after you finish the free case study and you want to join Investing Accelerator, then you can schedule a call with me. So the second link below is to schedule a call with me, and you can find a time that works for you, and then you can fill out the application form. I'll review it and prepare for our call, and then we'll have a chat. It's fairly straightforward. So I'll see you on the call. So thank you for watching, and I hope you enjoyed the video. please help support me by like, subscribe, and you can watch the next recommended video here as well. So I'll see you in the next one.